Hello, everyone, and welcome to the Nasdaq Dorsey Wright podcast for the week ending on December 20th. My name's Ian, and happy to be joined by Chuck Fuller.
Yeah.
Chuck, good to see you here.
Yeah, good to be here.
Yeah, absolutely. For those that might not be familiar, Chuck is a frequent guest on the podcast. We're trying to remember when I think you were on here 3 months ago-ish, maybe
Yeah,
September.
something like that.
Definitely try to get you on at least once a quarter. He's a busy man, hard to pin down. But Chuck is one of the portfolio managers here at Dorsey Wright. You've worn a lot of hats over the years. You work more on the portfolio management side now, kind of quantitative research. You also built the website.
Yeah,
So
whatever they needed me to
a
do.
lot of stuff. Yes, man, right?
Yeah.
That's it. Yeah. But we love to get you on here, especially to talk about kind of what's going on in the markets from the like a portfolio management side, but then how you as kind of a portfolio manager are viewing different indicators, what stuff you're looking at, what you're seeing moving around as we kind of wrap up the year.
Sure.
And it's been a pretty interesting year. I think if we had you on, we probably did have you on a year ago. I mean, you might have been guessed that the S&P was going to be up 25+% this year.
Yeah.
But I don't think many people were guessing that.
Yeah,
Right?
yeah, definitely not too many people. I think were thinking that we were going to get these kind of returns again, because it's one thing to get it in 1 year, and
Right.
especially like 1 year off of a bottom.
Right.
Right. That's
2022 is a rough year.
Yeah, 2022 is a rough year, so you kind of expected once things turn around, it's probably going to do it with a vengeance. That's kind of what we got in 23. But yeah, to see yet another year give you those kind of returns, and actually even a little bit better right now.
Right. Right.
We're almost at 30% a year.
Better for the S&P, not as good for the Nasdaq, but you're still at 30%.
You're still at 30%, right? It's nothing.
That's not bad.
Yeah, it's definitely not bad. So yeah, I don't think many people were seeing it. I think partially because, at least thinking back to the start of the year,
Yeah.
there was a lot of doubt still as to whether this soft landing thing could happen. Right. And I would argue that largely that's probably been realized now, right? It seems like that we're having a soft landing, the economy's still very strong. And I think that's, largely, or at least one of the main things that's helped boost up the stock market this year. Now you have that, but you also have, all the AI stocks, right? That's been a huge part. And AI was definitely something that people were looking at in 2023.
Yeah.
But I think people just keep discounting just how much impact that it's having. At least, if not from the impact that it's having in the economy as a whole, as various enterprises start to adopt it and all these kinds of things.
Right.
But just the amount of spending that some of these companies are doing is it's unbelievable,
it's
right? I saw a stat where the capex on these big AI companies, they spent like 125 billion this year, and they're going to spend 250 billion next year.
Goodness.
So I mean, all that money's got to go somewhere, right? It's going to go to
Right.
all these providers, to them, whether it's semiconductor companies or what have you.
And then that permeates through to you got to have electricity to power them. I mean, you're seeing it. It's just,
Utilities.
I don't think anyone, I mean, a year ago was looking at, well, you're going to see utilities start trading like semiconductor
Right,
stocks because
yeah.
they need power
They
plants.
need power plants, right? And so, yeah, that's something that, I certainly wasn't thinking about. I've never seen utilities act like this, right?
It's
we're in a year. I think when I looked at it, the utilities, I think they're lagging the S&P a little bit, but I mean, they're right up there with it. You know what I mean? It's something like they're up 25%.
when classically, if you see utilities outperforming the S&P, that's not a great sign.
Right, exactly. Yeah,
Right?
usually that means you're in a bear market.
Right.
And if you're in a
Safe
bull market,
defensive area.
right, if you're in a bull market, then the utilities should, maybe give you half the return.
Right.
So it's definitely a strange year. And a lot of people are wondering, well, can it keep going? Right? Is 2025 going to be it? Is it right now? Are we already at the top? Right? That's a lot of questions that we get from
Yeah,
people.
I've already seen it. Right?
Yeah, right. And and it's one of those things where, obviously we're going to say, you got to stick with the trend. You got to stick with where relative strength is.
We're not in the game of guessing.
Yeah, we're not in the game of guessing.
Right.
And by far, the U.S. equities is the number one asset class out there. I mean, really, if you look at the performance of U.S. equities this year versus all the other asset classes, and I mean, it's a stark contrast, right? You've got the number two asset class.
Except for maybe crypto.
Yeah, for crypto, yes.
But well, that's not in Dolly.
Yeah, not in Dolly. But yeah, looking at like the number two asset class, and this is me throwing in like real estate, right? Like real estate's number two, and I think it was up like 9.5 so far. So literally, there's a 20% gap between the S&P and the number two asset class out there. And so when you see equities be that strong against everywhere else, I mean, it's hard to discount it. It's hard to say no to it.
And the thought is it can't stick around for that long, but then we're in other looking at other indicators, and we don't have to dive into all of our indicators. But
Sure.
like on the group scores page, 134 different groups we classify stocks into, or ETFs and mutual funds into. The core S&P 500 is one of those. 97th percentile. It's
Yeah.
been above the 90th percentile for months, the
Yeah, for a
longest streak that we've ever seen.
long time. I
And
mean, I don't think we have data going back to the 90s, but I'm sure like if we did, like it'd have to be, the first time we've seen, this kind of dominance from the
right,
S&P since the 90s.
right, which is good for U.S. markets.
It's good for U.S. markets, right? The late 90s wasn't just a 1 or 2 year thing, right?
Right.
It was like a 5 year thing.
Yeah.
Not to say that it has to play out exactly the same,
I think that is interesting though. I mean, we have several other things we're gonna have, but on the late 90s thing, I keep seeing stats that relate this time to the 90s time.
Yeah.
And I think a lot of those stats that you're seeing, I mean, some, of course, when you get into 99, you start to like, oh, that's getting kind of close to
Right.
2000.
Yeah.
But there's a lot of like 95, 96. I mean, if we're going to get a down year in the future, it doesn't have to be next year. It could be, you
Right.
could see stuff like this persist for a little while.
Right. I mean, one of the ways, I mean, this is just me kind of speculating, but I mean, maybe, a 94 is kind of like a 2022. Right.
Ramp up to the internet, kind of like the ramp up to AI.
Exactly.
Yeah.
23, maybe it's like a 95, 24 is a 96. In that kind of analogy, then 25 is a 97. And I think markets were up somewhere around 30% that year. Yeah. And again, it's,
So that's your call for next year.
that's my call, right? Yeah. No, I mean, it's, it definitely doesn't have to work out that way.
Right.
But, it's just one of those things where there's some interesting parallels like between the internet craze back then and the AI craze now. It does seem like the AI craze now is more robust or more like we're further along in that game, versus where we were, let's say, a couple of years into the internet craze.
And I think an interesting point that you had, we talked in some notes about this beforehand, but are we in an AI bubble right now? Right.
Yeah.
And I think you're looking to that, like by classic bubble terms, not close.
Yeah, we're not even close to it. Usually like a bubble, to me, I'd say there's like two main things, right? You have obviously extremely good short-term returns,
Right.
which, arguably you could say we've had some of that.
What is short-term defined as?
Maybe like 3 months.
Okay.
Right. Like looking at, short-term period, have we seen the market just blow out?
Just keep going.
Yeah, relative to historical norms. I would say like around the election, we got a little toppy there, at least from short-term perspectives.
Right.
And really like earlier this year, like maybe in Q1, when I feel like the AI craze was really starting to take off. Things were getting pretty toppy from a short-term perspective. But it didn't have to me, the second aspect of it, which is the long-term bubble-ish kind of thing, where you have just extreme long-term returns too. Thinking about like, over a course of like 5 years.
Multi-year period.
Multi-year periods,
just continuous.
Right? Just continuous. I mean, all the major bubbles that we've ever had, we haven't had one in a long time. I mean, I'd say since the top in 2000, right? For after the late 90s.
Bubbles certainly in other assets.
But not in the US markets, right? But yeah, you look at that and really, I mean, that was like a 10-year period of just, and really, but the last 5 was just unreal.
Right. Right.
And then, you go back to, you could say, okay, the bubble in 87 before the crash of 87. And a lot of people don't realize, but that was extremely good too, over a 5-year period. One of the best we've ever seen.
Leading into the 87.
Yeah, like from 82 to 87 is
an
amazing time period for the markets. And so, yeah, when you look back, it's like all these major times where something really bad does happen afterwards. They're preceded by both of those things, right? Great long-term returns, like, more than like 3 standard deviations or whatever, like higher than what you're used to seeing. And then the same thing over the short term.
Right.
And right now, maybe we've seen some of the short term stuff, not currently, not like right at this moment. But definitely, I mean, we're probably, half of the levels that we would see from the long term.
Oh, wow.
So
when you're looking at, I mean, it would make sense if you have a lot of improvement, kind of like we saw in November. I mean, just big breadth thrusts, everything kind of going up.
Yeah.
You see some stuff going down. And it would kind of make sense. We were talking a little bit yesterday about if you have everything going up, then if it all starts to go down at the same time, it's kind of normal, I guess, to think about it.
Yeah, it's one of those things where, if the market pulls back and it's kind of a broad move down,
right?
It's actually, it doesn't tend to be as big a deal I think you tend to see more, kind of 10-ish% corrections that happen like that, where everything's just kind of moving down once. And it doesn't end up being a big deal. They're not markets that you look back and remember.
No.
You know what I mean? It's, oh, what happened there? Yeah, I don't even remember that.
Right.
And so, and to me, that's because it's like the pressure is being released. As it's like the market's moving down, and the pressure that was there before, it's being released as it goes down.
Right.
What can happen sometimes, and it's one thing we're kind of looking at right now, is these markets where let's say you're up around highs, but the average stock is just kind of is moving down. In that case, it's kind of at least from an analogy standpoint, the way I think about it is it's a lot of pressure is being built up, right, in the market. You've got, the market's at highs, but underneath the surface, things aren't looking all that great.
What kind of stuff do you look at to?
Yeah, I mean, looking at some of our, short-term indicators for things like that, it's maybe something like the TWSPX.
Okay.
Looking at the high-low,
So
MRT high-low.
TWSPX, for those who might not, it's the percentage of stocks in the S&P that are above their 50-day moving average, or 10-week or 50-day moving
Right.
average,
Yeah.
basically.
And so, what you want to see is that, hey, if we're up around highs, then, maybe
That's ticking higher.
Yeah, it's ticking higher.
Right.
Or, maybe above 70% of those stocks are, above their 50-day moving average. That would be a healthy, market. Right now, we're not really seeing that. There's I forget where the chart is right now, but it's somewhere in the upper 30s.
Down at 38. It's kind of interesting because we were up at 82 in September.
Right.
And then October came around, started backing off. November election came around. We moved from 48 in October up to 68
Right.
in November. Didn't quite hit that 70 mark and then turn around.
And then turn right back around. Right.
Yeah.
So, we're at 38 right now. We're still within probably a couple percent of the highs, on the S&P. And so that's kind of, I'm not saying it's like, oh, we got to sell. But it's something to keep in mind, because that tells us there's some pressure kind of building up underneath the surface.
Right. And this is something we haven't seen. I mean, we haven't seen it that frequently, but we did see it earlier this year.
Yeah, this year's been kind of strange. Usually you don't see, the TW get that low,
Right.
With the market at highs. But this year, yeah, we have seen it a few times, and this could be another false positive, like what we've seen this year. But this year, by far, like going back in history, has by far the highest number of times we've seen that happen.
Of these kind of divergences.
Yeah, at least for the TW,
Yeah.
right? So that's, it's a little strange.
Okay.
But it's not something I would say I'm really concerned about right now. I would be more concerned if we start to see something that's more severe out of something like the high-low. So the high-low has like a little bit of a lag in it too.
Right.
And so when you see it get down, let's say below 30, we're still kind of near the highs. That's kind of a strange market.
And so we're at 60% now for the high-low. And the high-low is it's looking at the percentage of stocks making a new 52-week high relative to stocks making any 52-week extreme.
Yes, right, exactly. It takes that ratio, puts it on a 10-day moving
So high or low on the bottom, just highs on the top.
Yep.
Obviously, smaller means less highs.
Yeah, exactly. Right. So, it means you're having some extreme moves, let's say, but you're having more or fewer that are going to the upside. Yeah. So something's going on. We put that on a 10-day moving average, just kind of smooth it out.
Because you could get one day reading where it's like 2 new highs and 4 new lows.
Right, that kind of thing. Yeah. And so, when you see that get really low and, we're still up near highs, that's telling you that the pressure's built up to a point that typically not so great things happen. Like I said, we're not at that point now.
We'll throw this chart in for those that are following along on YouTube. But I feel like this indicator is, I mean, it spent the whole year above that 30% mark.
Mm-hmm.
Did not do that obviously in 22. Didn't do it in 2023. I mean, saw a little more whipsaw action.
Yeah.
Most years, it's rare to see a year going back over the past 10 years that it hasn't. It's 2017, last time that we didn't get down below 30% in a year.
Right. Yeah. So, most of the time it goes coast to coast.
Yeah.
I think the difference is usually when it goes to the downside, the market's going down with it.
Right.
And so when the market doesn't do that and it's down the downside, that's the head scratcher, right? That means you don't have stocks hitting new highs. Hardly at all, but the market's at highs, right? So that's something straight. Last time we saw that was kind of late 2021. And so obviously bad things happen from there. But it does tend to come uh, before you see bad things happen in the market. But it's not the type of thing always where it immediately happens, right? There's, but it tells you that, okay, something's brewing. It could resolve itself, but more often than not, it resolves itself by the market falling, at least some, you're right.
And I think that, so we were chatting before and looking at this indicator kind of helps measure like I guess the magnitude of weakening breath.
Yeah. I mean, again, yeah, if you see this, very low, but hey, the market's near highs or not too far off from highs, that's a sign. That's a weird market. Like if you go back to the late 90s, for instance, obviously the late 90s, the market, let's say 99, really. The market's screaming, right? Obviously, we're hitting new all-time highs all the time, right? But if you go back and look at the high low back then, it's in the teens.
Oh wow.
Yeah. I mean, it's
so you've seen some pretty major divergence.
Major.
I mean, 60% is not that by no means we're not there.
60%. I mean, it's a little bit, but it's not that bad.
And so when we're looking at, there's been a lot of, I feel like, conversation over the past week around breadth for markets, maybe just because people don't have anything else to talk about.
True,
but
right.
I mean, I think, what is it, 11 or 12? We're recording this on Wednesday. So 11 or 12 days of weakening breadth.
Yeah. So what you keep seeing is the number of decliners.
Right.
In the S&P. It's been negative for 12 straight days.
So decliners are outpacing advancers.
Right. Yeah. So you've had that for 12 straight days. I don't put too much credence in like streak indicators like that. Like
it's good to grab headlines.
It's good to grab headlines, but like, things can streak for any number of reasons.
Right.
And it does, like, I think we talked about this before where it's like, well, in some other case, you might have, 6 days where it's bad and then one random day where it's not, and then another 7 days where it's 10 days where it's bad, and so
that streak would have been longer.
The streak would have been longer that one day, right?
That happened to be the day before Thanksgiving or something. Like, who knows?
Yeah. So I don't worry too much about the streaks. I again, going back to what I was talking about before, like I worry more about the severity of the divergence. And so, you don't like to see obviously 12 straight days of,
it doesn't help the readings.
Yeah, it doesn't help the readings. But I don't think that in and of itself is cause for alarm. It kind of goes back to this other thing you keep seeing in the headlines with the Dow, right? What is it? 9 straight days, I think, of the Dow's down 9 straight days in a row, something like that.
Yeah.
It's another one of these streak indicators, and it's actually, when you look back, I was looking at it yesterday. It's like, okay, if you hit 9 or more in a row. I don't think it's happened since the late 70s. But when you look back, let's say to World War II, all the times that it's happened, it's like the market's up 25% a year later. You know what I mean? And not to say that that's the reason, but
we've looked at similar stuff for the S&P, I think, on like consecutive weekly declines. When we get a streak that's kind of running out, and I don't know, I feel like you see stuff like that with streaks. It's immediately after that, you would expect maybe a little bit of a
pop or something, right?
But it's not. It doesn't affect the long-term picture that much. Every market environment's a little bit different.
Exactly. Yeah. So again, I don't put as much emphasis on the streak aspect as I do the severity of the divergence. And right now, the divergence isn't severe, but that could change. That could change fairly soon, right?
So, the NYSE low is the 60% is one you're monitoring. It tends to move pretty quick, and as you say, it goes to coast to coast. So that's definitely one to keep an eye on as we look toward 25.
So again, if you see it fall and the market's still at the highs, then that's pressure's building up. It's more something to worry about.
And then the 10-week at 38%, that's again another area to monitor. It's not great, not bad, but just another shorter term.
Kind of strange. Yeah, kind of strange. Telling you that there's a divergence there, and tells you that, hey, maybe because the high low has a lag, maybe the high low, it could be telling you what's going to happen in the high low.
With the high low, I think the NYSE constituents have a more representation, obviously, than 2/3 of the representatives are mid cap and small caps.
Right.
I mean, what kind of effect do you think that has on some of those?
Yeah, I mean, it certainly has an effect. Obviously, small caps haven't been that great.
Right.
Although I will say in the last 6 months, they have come back.
That IWM chart looks pretty good.
And I was looking at the raw performance yesterday, and it's like the The Russell 2000 has outpaced the S&P over the last 6 months. And small cap growth, it's up like 10% more than the S&P
Hmm.
over the last 6 months. And so it's, we're starting to have this kind of, I don't think a lot of people know that, right?
Right.
And so we're starting to get this kind of move, the other way. Who knows? Maybe it's time for them to shine, but it's one of those things that we've been saying for a long time. They're due, right? Just
Right.
they can be due for a long
They
time.
can be due. I mean, that international stocks, other places. I was just
Yeah.
pulling up here. You were talking about the last 6 months. Yeah, I mean, you have IWM up 15% over from June 17th through
Yeah.
December 17th. S&P's up 10% over
Right.
the same time frame. I think
Hmm.
another pretty interesting point, and we were talking a little bit about this earlier, when you're looking at maybe more focused areas in the US, another huge, it's kind of surprising thing, software and semiconductor. So
Yeah.
IGV software, semiconductors, SMH on the semiconductor side. IGV is up 25% over the past 6 months.
Hmm.
SMH down 8.
Wow. Yeah.
I would not have guessed
Yeah. I
that.
would not have guessed that.
I mean,
Right.
as you've seen in looking at some of the more focused areas, it's just some other stuff showing some improvement. Maybe if it's not affecting the breadth indicators as much in the near term, could be kind of what you would expect, or could be good for the broader market with some other stuff. Even if semis aren't blowing off 100% a year,
Right.
software up 25% in 6 months,
It's
pretty
not
good,
bad. Yeah.
right?
Yeah. That's what's been so good. Feel like over the last, at least few months where, maybe some of these stocks that have been the darlings at the beginning of the year kind of faded a bit.
Mm-hmm.
But they had passed the baton, right? And that's really what we were looking for. That's a sign of a healthy market.
Right.
Is that the baton got passed, things like financials started to do
We
well.
had some model rotation with financials
Yeah,
showing some improvement, which, I mean, financials have been showing improvement for months,
right,
right?
exactly. Yeah.
It wasn't just the election that,
Yeah.
but
But
that's,
they kept their strength,
yeah,
right? That was
yeah,
it
yeah,
wasn't that, oh, everything's rolling over now, because the market leadership
right.
is, right? So I think that's a healthy sign. Yeah, we'll have to see. Tech we just saw like move back to number two,
After
and
being at 4 2 weeks ago.
at four just 2 weeks ago. So it seems like maybe this kind of decline in tech is fairly short lived. It's going to come back. I would imagine it would. I mean, it's again, I feel like there's just so many economic tailwinds, going
Right.
in tech's favor. It's going to be hard for it to pull back, but so much without the entire market,
Right.
pulling back.
Given how, especially how overweight most of the market is towards
Hell
that.
yeah, it's like over 30%
Yeah.
of the S&P.
Yeah.
So yeah, absolutely.
But if we see some of those areas, I think, I mean, interestingly, from like momentum, from our stuff, has it been consistently overweight tech, overweight financials, and like what has been kind of like leading the way on our for most of our product side, I guess.
Yeah, I mean, obviously, we've been in technology,
Right.
for a bit. We have seen some of that start to cycle out. Things like financials come in. Industrials, depending on the stocks, have been fairly strong.
Hmm.
Communication services is up there.
Yeah.
So there's other places, in the market. It's not just a tech thing, like kind of what I was saying before, but it's good to see for
Right.
sure.
And those that is, I guess, one of the benefits of our approach, that if tech isn't as great as other areas, you can go into those other areas. It
Right.
doesn't
Yeah.
have to have 25% exposure toward tech.
Exactly. Right. That's
Um,
exactly right.
so in looking at some of the other stuff, so if you have a couple other questions for it, what do you think as we look toward next year?
Hmm.
Obviously there's a lot of conversation. The election was pretty good for markets in the near
Yeah.
term. What do you think is maybe a big risk that we could be looking toward next year?
Just from like a economic standpoint, or just the market as a whole, or just
Biggest
whatever.
risk for
Business
2025?
risks I see. I mean, yeah, it's hard to say. I mean, obviously, this breadth thing that we talked about is a little concerning from a technical perspective.
Right.
If we talk about, more economic things, I mean, obviously, everybody, whether you like Trump or you don't like Trump, like he's not the status quo,
Right.
right? Like, so I think there's a lot of worry out there from people that, he's going to come in like a big wrecking ball and maybe screw things up. Economy's good, he's going to screw it up, maybe. Who knows? I worry less about that.
Well, we were talking, just to go into that a little bit. We were talking a little bit about that earlier, that I mean, that same fear was there the last time he was in
Oh,
office.
absolutely. And
And
he
then
was,
you look toward even more so because people had no idea.
we had no idea about him last
Absolutely
time.
no idea.
Right. We've had 4 years of him now.
Right,
Right.
right.
So we at least kind of know.
Maybe everyone thinks they know, and I mean, who knows?
Right. Yeah.
But I mean, you look at that first year of him, the 2017, lowest volatility year we've seen in ever, if a long time.
Yeah. I think you got to go back to like the early 60s
The
to
VIX are
see.
just consistently low levels.
Yeah. It's some of the, I think the worst pullback that we had was less than 3%
It's
in the market.
crazy.
And that's, yeah. And and that was Trump's first year being in. And so what it shows you, it doesn't have to be the same as that.
Right. And there's a
But
lot of stuff different, like he
right.
split Congress versus combined, like
Yeah.
all that type of stuff.
But what it does show you is that it doesn't have to be crazy.
Right.
Because he's this firebrand, he wants to, take over the status quo and all that.
Yeah. Yeah.
It doesn't have to be crazy. And my thing too with him is like may seem like he doesn't listen to anybody or all that kind of thing. And it's like I think there's one thing that he does listen to, and I think that's the market. You know what I mean? Like I think that he's the type of guy who, if he's doing something and he sees that the market doesn't like it, is moving the other way, that he'll, reverse course and
He tweets or I guess truths about a lot about 401ks.
right, yeah, right, yeah. So you talk about tariffs and all these different kinds of things that I don't think hardly anybody's a big fan of the tariffs, right? They're kind of damaging over the long term and that kind of thing. But again, like if the market gets spooked by him, then he's probably gonna roll back whatever he's doing.
There could be some,
and that happened last time, right? He had tariffs last time and all this kind of stuff. The market was kind of like, okay, yes. I don't remember it being like it may.
A lot of them are still on.
Yeah, right. He didn't like Biden didn't take them off,
yeah,
right? So it's like they're still there. So I don't think that side of the ledger is
so no risk for 25. Is that what you're saying?
Well, yeah. Right. Again, like these technical things,
The breadth
thing is like, and it really up until like a week or so ago, I would have said, well, we don't have any problem there, but
and that thank God you didn't, right?
right, yeah, exactly, yeah. So yeah, that's kind of the one thing I see. Maybe you could say this whole Doge thing, right? The Elon and company are looking to do
government efficiency.
Right, you're right. Maybe they cut, a little too close to the bone, right? And because you got to figure like the government's 18% of GDP, right? So maybe probably shouldn't be that high.
Right.
I'll make that statement. But fact is, if you cut, right, that's money going into the economy that could cause issues. Now the way he's kind of talked about it though has been, hey, they're not just gonna, fire all these people and then they're out on the streets, right? They're talking about giving generous severance packages, so all these people will still be getting money that they can put in the economy. So I don't think it'll be an issue for 2025. They'll probably spend a decent amount of 2025 just figuring out what they're going to do. Right. So I don't think that it's a tremendous risk for 2025. Although people are going to talk about it for sure.
Well, I think they set a deadline of the July of 26. I think
it's when they want to be done with it.
When they want to be done with it, right?
So yeah, they're going to have to probably start this year if they want to. You're right.
Right.
So, but I look at it as probably more of a latter half kind of thing, probably.
Mm-hmm.
So I think that's a risk. And you can always say, hey, valuations are high, yada yada, and sure they are.
But they have been.
But they have been. And again, valuations are not a great timing tool, right? Yeah. They can stay, elevated for a long time. The late 90s, like we talked about, was obviously a case for that. I always bring up the point that, during that, roughly 5-year bull run, Greenspan made his famous quote, which was, the irrational exuberance. That's, the market's exhibiting irrational exuberance. And, if you don't know, like when he said that, you might think he said that in 99, like around the top. But no, he said that in 96.
And had 4 pretty good years of returns.
Yeah, you still had 3 or 4 years of great returns. And so, yeah, you can't use valuations. At least as your sole barometer. It can kind of tell you, things don't look great, from that standpoint, but you got to use other things.
So the breadth deal, maybe some Doge concerns.
Yeah, beyond that.
I really thought you were going to go with the drones. Okay,
The drains are weird. Yeah, I don't
We
want to
don't need to
comment on that.
dive into
I
that.
don't know what's going on there,
But
but
so, okay, so flipping the question around, looking at it from the other side, what biggest potential or like opportunity in 20, not necessarily like give me your stock pick, but like what
yeah.
do you think could be a good tailwind for 25?
Yeah, I mean, I think that there's a lot of things that are interesting, at least from an economic standpoint. Obviously AI is still gonna do its thing.
Hmm.
To me, I feel like it's probably more undervalued than overvalued. And I don't mean necessarily in terms of the companies and their PE ratios and that kind of thing. I think more of people might be still underselling future growth.
And I think about future growth in different areas. Like you think about what other, like I was listening to people talking about like, okay, well maybe healthcare is looking really bad right now.
Right.
Like what if AI starts having an effect in some healthcare company? Like
Yeah.
who knows what's going to happen in
Yeah,
the future,
it's
right?
hard to say. But it does seem like, this time for AI is definitely different than any other time.
Hmm.
Because AI has had this long history of, they call it like AI summer and then AI winter, where, AI summer, there's all this hype, because even going back to the 50s, when it
Right.
first started, people kind of knew where it eventually would get,
You could see it,
but
yeah.
we were a long way away from that at the time. And we still could be to some extent, but it does seem like
It's pretty cool.
it's much further along. We actually have products we can I use ChatGPT all the time,
Yeah.
right? Like, and now Google just came out with this Gemini stuff.
And that new chip that they came out with too, the kind of quantum computing thing
Yeah, right.
that's
So there's all kinds of things that are kind of brewing that I think are interesting.
yeah.
And the thing is that all these AI companies, beyond the fact of what they're what they're doing right this second, they're all poised to spend a tremendous amount of money. Like we said, like they're going to spend $250 billion
It's
on,
insane.
yeah. I mean, and all that money is going to trickle out into the
Right.
economy. So I still see that as being a huge thing. And in the small caps, like what we talked about before with small caps. The other side, small caps is, they've kind of been in a recession for the last 2 or 3 years, right? Like just, at least from an earnings
Right.
perspective, right? They hadn't really been making money. Um, at least, according to consensus, and take that with a grain of salt, but consensus says that this is supposed to be the year when small caps break out, at least from a profitability standpoint.
Right. Rates continue to come down. Ultimately,
That helps
that's
them,
better
right?
for
They
small
have a
caps a
lot.
little bit more so than
Yeah,
cash heavy
right.
large
Yeah,
cap space.
small caps have a lot of floating rate debt, so they're
And we're recording this before the Powell
right
conference,
before it,
right
right? Yeah.
before, so we'll see what happens. But I mean, the expectation has been we've seen the rate cuts started. The expectation they would continue in some form or fashion for at least the very near term foreseeable future
Yeah.
should be good for small caps.
It should be, right. And so we'll have to see if it translates, next
Yeah.
year. But I think, they seem poised. If that profit situation does start to move up,
Hmm.
and I think that's the thing, is it's probably being discounted now because everybody knows that, okay, yeah, at some point it should happen,
Right.
but they want to see the beginnings of it actually happen. They don't want to just guess that, like, okay, yeah, it's going to happen
And they
this
need
year.
confirmation.
They need, yeah, exactly. Just
Yeah.
like anything else, like if you're doing things and you're being, prudent with it, yeah, you want to see confirmation out of
Yeah.
these things.
Yeah.
And so I think once that starts to happen, it could be it could break the dam on small caps.
There you go.
But we'll have to see.
We'll see. I mean, that's why we have the indicators and stuff to look at, so we can
Yeah,
kind of keep
you
track of
got
it.
to have the soulless barometers,
Yeah,
right?
exactly.
As Tom Dorsey used to say,
Yeah.
because otherwise, you can get off on any kind of narrative you
Yeah, you
want.
don't want to go down a wrong path, that's for
Right.
sure.
Yeah.
Yeah. We'll keep it on the right path for 2025.
We'll try.
Great. Anything else you want to hit on, Chad?
No, I think I'm good.
Awesome. Well, thanks for hopping back in again. We'll try not to go 3 months before having you back on next time. If that works for you.
That's
So,
fine. Yeah.
okay, great. And thanks everyone for tuning in this week. We'll be back to touch base with you soon.